We are Fyde Treasury. We are building our startup to really solve the treasury management issue that happens to really all crypto companies when they hold assets on chain. And we're doing this through the creation of on-chain indexed liquidity pools. It's effectively liquidity pools, but introducing dynamic weights so that the assets can be kind of shifted around as needed to replicate a typical index fund, which we believe is really the best way to diversify risk. So I think why this is kind of the right time to do this is that as we've seen over the last year, crypto is highly volatile, but there's also issues in the traditional finance space with banking failures, right? So there is an increased need and an increased importance to hold assets on chain. But the majority of current protocols, current tokens, they use really unsustainable kind of metrics, right? They hyperinflate their token. Oftentimes they actually increase risk when they claim to decrease risk. And what we're looking to do is really create a one-stop sustainable system where crypto companies can essentially outsource their portfolio management to us, this autonomous system that we're building, in order for them to really gain the upside that crypto has to offer without having to have a whole team on staff 24/7 to look out for things like depegs or hacks. So kind of just the way that this works, we are actually building this from a traditional finance vehicle called an exchange fund. So an exchange fund was traditionally built for startup founders and executives, where the majority of their net worth was in shares of their own company stock. So what they would do in those times is investment bankers would go around to about 30 of these different founders. These could be the founders of Apple, Netflix, executive at Goldman. And as a way for them to hedge their net worth, they would deposit shares of their stocks into the vehicle, and they would get the returns of the overall fund. So we're bringing this on chain. We believe there's actually a really good use case for companies like DAOs, for example, that have the majority of their crypto treasuries in their own native token, but can't really sell them because by having too much of these tokens, they create this imbalance and they end up crashing the price of their own token. So the market for this is huge. We initially built this for just DAOs because us as founders, we had built a few DAOs. We built the DAO at London Business School and really bullish on that sector and really interested in innovation it brings. But our client base has really expanded to other crypto companies, groups that maybe get paid in different tokens from other DAOs, even founders, but also groups like family offices and investors that want to have this index type of exposure on chain. So we've had a few of those clients as well. So just a little bit more about the issue specifically with DAOs, right? If you look at the top DAOs, a lot of them have billions of assets in their treasury. If you think of like a Uniswap, if you think of like an Aave, huge companies, 99% fully concentrated in their own token. So when I first saw this as a CFA charter holder, I realized this makes no sense. You want to diversify away risk. But it's really because there's an infrastructure issue. So for example, if Uniswap wanted to sell even 2% of their native token to start diversifying into even like things like Cash or Ethereum, they would actually crash the price of their own token. So not only would they actually get back less money because of slippage, like a 10 cents on the dollar type of exchange, but they would also wipe out about $1 billion from their current holdings. So it's really a situation that makes zero sense. So when we got our heads together and identified the things that need to come together to really make treasury management work, it's really 4 fields, right? It's diversification, which we're solving through our vehicle, where people that have the tokens on our whitelist can deposit directly into this vehicle. And in return, they'll get back what we're calling the treasury token, which you can think of as like a share of a mutual fund or an ETF. And since there'll be a lot of other tokens being deposited into this pool, you get instant diversification without having to manually sell into different assets and manage that yourself. Now, when they have this, and so the assets in the pool as well will create yield where we can by staking different assets, by bringing on stable coins that, for example, are bringing in treasury bonds on chain, which for a lot of these native DAO tokens, it's really hard for them to generate sustainable yield. And we're also allowing proxy governance voting because when a DAO goes to sell their token on the open market, they open themselves up to governance attacks. So we are allowing the delegation of their deposited assets so they can still participate in the voting process and still participate in their governance as needed. And the other thing that we're very focused on doing is that when the holder has this treasury token, we want to also introduce more of this Visa type of model where people can use the treasury token as a means of payment. And because we're fully backed by like at least 50 different assets within our pool, we can kind of spread out that sell pressure. And we're also introducing protocol-owned liquidity, which means we want to incentivize people to open up Uniswap LP pools for us that we will then kind of buy from them in exchange for an incentive. So really, this will work as a mechanism to create a kind of really balanced and sustainable ecosystem. On the back end, it's complicated, but on the front end, we want to make it super user-friendly and gamified, where people can simply go on our site, they can deposit multiple tokens in that are whitelisted, they can swap tokens in and out in order to help us balance the pool. So having this kind of gamified version of it, and then they'll simply be able to go to our governance section so they can redelegate the voting powers to whomever they want to, and then still go on Snapshot or still go on the MakerDAO forum, for example, and continue to vote as they normally would whenever. So this is just a little bit about how the exchange pool works, as I mentioned earlier, where people would deposit this pre-vetted list of assets. There'll be concentration limits as well within the pool. So as in order to kind of not create a 80% Uniswap pool, we want to really kind of diversify the risk. These are kind of the 4 different things that we're covering. Just a bit about the team, very experienced team. Our CEO, head of investment, was previously JP Morgan's Chief Investment Office Group, leading up their blockchain research. We all built the London Business School DAO together. We have numerous PhDs from Synthetix, Wintermute, Ocean Protocol, groups that have experience building agent-based simulators, for example. Our CFO was on the board of one of the largest private equity firms in Africa, focused on fintech investing, and he helped launch a few exchanges. So that's really going to help from the regulation standpoint. And our CTO was previously at NASA, an assistant professor at Stanford as well. So just in like the last minute, I guess we have 4 revenue streams that we're creating. The largest chunk will come from this protocol-owned liquidity, which is really like this market making angle that we're building up towards. All of those revenues will flow to our own governance token that we're calling the Fyde token. And the Fyde token is introducing a few different novel bonding curves in order to, one, accrue value to the token when the market is moving upward, but they're in certain time periods, call it volatile market environment, they'll have an inverse bonding curve so that we can inject liquidity into our system in order to act like as a backstop to prevent these kind of runs in the bank that occur in crypto and in traditional finance, right? So just a little bit about our investors, led by OP Crypto. We have Arrington, a good group of angels as well. So kind of very strategic guys that have helped us really build our initial client base. We have about 50 different clients on our wait list, 10 different LIs from groups like Arrington and Merit Circle, and then quite a few others. We expect to launch at about at least 20 million TVL on day 1. So just a little bit extra, but I think I'll kind of skip over this. And just roadmaps, finally, we expect to launch on mainnet towards the end of summer, and our own governance token will launch at the end of the year. And that's when we'll start transitioning into a DAO. So yeah, that's really it. I appreciate your time. I know that's a lot. Happy to answer any questions.
All right, thanks, Carlos. We'll move into the Q&A now.
Thanks, Carlos. I must say your pitch deck is worth spending the whole evening with a bottle of whiskey, I guess, to understand all the complexity, all the stuff. And that being said, you mentioned one case, for example, Uniswap, if they somehow decide to liquidate 3% of their treasury, let's say they need it quick, right? So something happens and they need cash, and so if they do it the current situation, they will lose, as you said, like 80% of their market cap currently. So if there are your clients, for example, let's say Uniswap is Fyde clients, what exactly, in layman terms, what exactly will happen from the business perspective that will prevent Uniswap from losing market cap, but still getting that cash that they desperately need in case they decide to liquidate 3% of their treasury?
Yeah. So I'll caveat it. Obviously, we'll have to grow into that type of allocation, which is one of the beautiful things about this exchange fund model, in that the more it scales, the more you can diversify away risk, and the more you can kind of take on these large allocations. So assuming we're at the scale where we have room for 3% of their treasury, what would happen is that they would deposit that directly into our protocol and then mint back the equivalent value in our treasury token. So it doesn't actually hit the open market sale. You can almost think of it as being locked in a vault, right? So now that Uniswap has this treasury token, if they then do want to like exchange it, obviously you can send it to a peer. But let's say they just want to actually move it into cash at that point, or it's a stable coins or off ramp it or something like that. So we have a redemption mechanism as well. So similar to how USDC works, similar to how ETFs work, right? So they would sell it on the open market. And then there's a few different mechanisms from there that we implement to kind of spread out the sell pressure, right? At the very minimum, we're working with market makers so that they can facilitate this redemption process. The market maker can then go in and they can essentially deposit the treasury token back into our protocol. And what they would receive back is a handful of tokens. So they would receive back a combination of the tokens that are most overweight in our protocol, but then also like a basket that represents the underlying liquidity. So similar mechanisms to how an ETF works. So in this way, we can, instead of selling one token on the market, we essentially sell bits and pieces of a lot of different tokens, right? So even if we get back 10 tokens, all of a sudden that sell pressure is 10x less, right? The other thing we're doing is this protocol-owned liquidity mechanism. So one of the reasons why there's so much slippage that occurs is because of the concept of impermanent loss, right? So you have this two-sided bonding curve, just say ETH and Uniswap, but then as the prices converge when there's very volatile environment, what these autonomous market makers do is they'll unwind their position, so they don't have to suffer from impermanent loss. But what that does is it makes it so there's less liquidity in the system when it's needed the most, when the market is most volatile and people want to get liquidity. So it causes a lot more slippage, and increasingly so, right? So the bands of the trading volume become much narrower. But for us, we are, instead of allowing those groups to unwind their positions, we want to buy those LP tokens from them. In exchange from we're essentially giving them the Fyde Treasury token at a slight discount to the market. And the Fyde Treasury token is fully backed by the revenue that the protocol is generating. So they can then sell us the LP tokens. They can take the Fyde, sell in the market if they need to. But then the protocol owns these LP token pairs. And we're not interested in unwinding those or timing the market. We want this to be a permanent base of liquidity. So over time, as we reinvest into these LP tokens, we'll start having more and more pairs. It'll be Treasury USDC, Treasury ETH, Treasury Tether, for example. And over time, then we can even expand into other different token pairs to really expand the optionality of the liquidity that we can kind of help flow into the system to really aggregate and disintermediate the sell pressure. Because the really fundamental issue is that Uniswap has 2 token pairs. And we want to make that optionality amongst as many different tokens as possible all at one time.
Thanks, but am I right to understand that actually you will be only able to manage such treasuries like Uniswap, for example, if you already have much higher liquidity in your system? So, I mean, like, this is the hen and egg problem here for me. I mean, like, to attract a lot of liquidity from players like Uniswap or any other huge treasuries, you need to show them that you already have much more liquidity in your system. So how do you plan to join the market with the huge liquidity already in your pocket?
Yeah, so the large decentralized DAOs, that'll definitely be a client base that we have to pursue a little bit later. Just going after governance proposals, it's like running for politics. We have to show track record. So initially on day one, we are getting clients that are kind of outside of that. So some of them are just service providers that get paid in uni that might still have $1 million or $2 million in assets, or just kind of some family offices that just want to have an index. But what we can do within the pool, let's say someone just deposits USDC because they want this index exposure, then we can sell that USDC and accumulate the rest of the assets that we need in order to create this diversified pool, right? So the goal is to start at about 20 million, which is what we're going to do now. That'll amount to a certain amount of liquidity thresholds, and we really want to test that out. And then as we start getting more and more deposits, and there's also an incentive mechanism within the protocol to essentially help grow the assets in a sustainable way, right? There'll be penalties when we have too much of one asset, for example. So no one can just dump one particular token and cause this systemic risk. So as the value of the TVL grows, then we'll be able to kind of get more and more bigger clients to come and deposit in. But for example, one of the clients that we're speaking to a lot are some of the largest Bitcoin miners in the world. And they could deposit wrapped Bitcoin, which is highly liquid, which we could sell at scale and diversify across the board. And for these Bitcoin miners, they have the same issue where their revenue and their expenses don't really match, right? They need to break that correlation. And they realize that the best way to do that is to diversify. And by then also be able to generate yield, it's like an additional bonus for them where they can actually create a more sustainable company.
Thank you.
Right, Carlos, thanks for sharing. There's actually a question from our audience. It's from Harry. By spreading the sell pressure, doesn't this mean you are devaluing the other tokens? And how does a protocol manage their risk exposure to collapse of other tokens?
Yeah, so I'll start with the last one. So by having this dynamic weight system, we're also building momentum indicators. So we've developed things like several different nodes, for example, to monitor as the on-chain transactions come in, as well as kind of different pricing feeds. So the goal is that we would monitor different indicators on like a tick level basis, block level, 5 seconds, 10 seconds. And then if these indicators start breaching downward too quickly on like let's say 2 standard deviation level, then we can quarantine those assets, which is a unique aspect to what we're doing. So when they're quarantined, we'll stop rebalancing into those assets so that then at least we kind of segregate them. And if they keep breaching these levels, we will eject them from the pool, either through incentivizing swaps, but also through just kind of open market sales across different DEXs and SEXs to really kind of hopefully mitigate this pressure, right? And it's because it's always a risk, right? Even USDC, which previously was thought to be the safest thing, depegged at one point, right? And that became an existential risk for a lot of these projects. In terms of devaluing the value of the token, the studies that we've seen when ETFs were first introduced in traditional finance, the liquidity and the kind of upward volatility, so upward price movement for the tokens in those indexes actually improve. And you see that when a new project gets introduced, like the S&P 500, for example. So we expect something similar. The big question is on the liquidity, like how much can we sell at one point, right? Because liquidity is nonlinear. You can sell up to a certain amount, but then once you hit this inflection point, you really start having to take on less and less value for a sale. And that's where our portfolio management mechanisms come in at. We really want to, we're really building the algorithms to really price that in and to really help, that'll kind of go directly into how much tokens we'll take in and then our incentive mechanism, right? So we start getting close to the point where if we do start having to sell, we breach into this concentration limit and we cause an imbalance in like the order book or the liquidity pool, we'll start lowering that token allocation slowly but surely and really doing things in over time and not all at once, which is where really you get this downward pricing pressure.